as we get started, let me go over our disclaimer. As always, I need to remind everybody about the risks involved in this market. You can lose all or more than your initial investment if you're not careful. So please be aware of how many pips you're risking on each trade, in addition to how big your lot size is, and ultimately how that would affect your account if you were to lose money. So make sure that you're going through that process each and every time that you take a trade. Just to introduce the topic real quick, we are going to be talking about risk management. It's been a few months since we've gone over this basic training call, so I thought it'd be really important to go over today. Um, I'll also tie it into a couple of the trades that we're taking. We'll talk about risk management in regard to the weekly trades. We'll talk about the price action trades and the overnight strategies. I noticed I've been talking to several traders this morning in one-on-one calls and through messages and such, where a lot of traders have been taking the other breakout trades. So you've got the Tokyo session, you got the London, you got the New York session, all these different sessions that you can trade that breakout strategy. So we'll talk about how to manage risk if you're going to trade all three of them and so on. So I think that'll be really good. So as we get started, we already went over the disclaimer, but let's jump into this. So first, let's talk about the importance of risk management and then we'll get into on the next slide the different tools of risk management, like what you have that you can control. Because in trading, there's certain variables that you can't control, but there are also other variables that you can control. And so, really good lifelong lesson is to learn how to control the variables that you can control and not only control them, but be very good at controlling them because there's so much that we can't control. Just like in every facet of the things that we do, and especially in trading, there's a lot that we can't. And so we have to become experts at the controls that we have, right? We have to be very good at conceptualizing different risk management concepts. We have to be very good at managing our risk. We also have to learn how to manage our own personal emotions when trades go in our favor and when they go against us. It goes both ways. You have to manage your emotions, not just when you lose, but also when you win, right? These are all very important concepts to be aware of, right? So let's talk about, like I said, the why manage risk. So the number one reason why we manage risk is to preserve our capital, right? And so each one of us, when we trade, we bring our own money to the table, whether that be through a prop firm, or I guess we bring other people's money to the table, right? If you're using a prop firm, or if you're bringing your own money to the table, right? So, like if you start trading and you decide to deposit your own funds with a broker, right? You're bringing your own funds to the table. And so that's hard earned money. You probably earned that from something else besides trading. That could be earned income, it could be rental income, it could be an income from a business or an investment. Either way, it's your money and you brought it to the table. And so we got to preserve what we have, right? Now, you've probably heard the term or the saying before, you've got to have money to make money. Well, it's very true with trading, but with that said, we have to learn how to preserve it, right? The other reason to manage risk is so that you can have a good long-term career trading, right? So if we're not very good at managing risk or we disregard it as not that important, we won't have a long-term sustainable way to trade in the future, right? So I see a lot of people quit the markets when they're down. And so very few people throw in the towel when they're doing great, right? Like nobody throws in the towel when they're doing great. It's always when people are having a losing streak or not doing very well. And so that's when they throw in the towel. So the way you're going to avoid throwing in the towel is to protect yourself from the very beginning. So if you force yourself to use a lot size calculator, which is one of the variables you can control, we talked about that earlier, right? If you build that into your routine, you're less likely to quit and you're more likely to be successful and have a great long-term career trading, right? So yeah, as far as stability goes and sustainability goes, specifically sustainability, that's why we manage risk, right? Emotional control. So this is a big one. I would say I'm kind of a touchy-feely guy. I definitely have my emotions, and if I watch a Disney movie, like you'll bet I'll be crying at the end. You know what I mean? Like that's just how I am. Um, so I get into things, if that makes sense. And so I recognize that about myself. And so I've learned how I have to learn how to have emotional control, right? Like, and view things separately and put things into their own little box or corner. And then and it's been a process. I've had to learn how to do that. But you have to recognize if you're that type of person. Maybe you're already equipped that way. Maybe you're the type of person that's really good at separating your personal life from trading life. And maybe you're really good at separating, like if you have a job and you're good at separating your job from, date night or whatever, you know what I mean? Because I mean, I've seen this with myself, no, before I was married, when I used to go on dates, nobody wanted to hear about like, oh, how's your work going? Nobody wants to know all the specifics about that, right? And same things when I take my wife out on a date, she's really kind and nice to me, but you don't want to like overstep and bring your everything about your business into your conversations, romantically or whatever, right? So this is a real challenge for a lot of people, and it was for me. And so to overcome that, you just have to almost create these boxes in your mind where you kind of like, okay, the way I actually do it now is I actually view myself as if I'm wearing a ball cap. And right now I'm wearing my Trading with Steve ball cap as I'm talking to you, right? And then tonight when my wife comes home from work, I will put on my husband cap, and whatever husband does at night, like go on a date or whatever. And then I won't be thinking about trading as much, right? When I'm coaching folks, I have to put on my coaching hat, right? So you have to kind of separate things, or when I'm hanging out with my family, I have to do that kind of stuff. And this is really important stuff, just because I've noticed what happens with trading is when you have a big win in the market, let's say you have a great week trading, it's really easy to let that get to your head, and we have to learn to let that go. It can't be, that can't be something that um, controls us, right? We have to let that go. It's same thing with losses. If you have a losing week or a losing period, you have to be able to put your trading cap on, and then when it's time to take it off, it's time to take it off, right? Really important to be able to do that. Plus, if you don't do that, you'll tend to not trade as well because you'll be emotional about the trades that you do take. So don't get me wrong though. When I have a big, let's say we hit a big, we're actually due for a pretty big overnight trading win in the next couple of days. And so when that day comes along, I'll be really excited. I'm definitely going to be posting about it on social media when I get that win tonight or tomorrow or whenever it comes along. I'll be posting about it, and I'm going to be excited. But to me, it's just business as usual, right? Same thing when there's a losing trade. I just log it as a loss, and it's just, well, it's like, okay, that was a losing trade, business as usual, right? Very important stuff to be able to do that. And take this not just to trading, like literally take this to everything else that you do. If you run businesses or if you have a job that where you do things, take that same mentality, um, and you'll actually be more effective if you put your work cap on really well, tighten like really tighten your work cap on when you're at work, and then when you're off of work, get really good at taking it off quickly and then putting your other cap on, and you'll actually do better in your other facets of life. Okay, so I'll move on from here. So mitigating unexpected events, and you got to manage risk, because a lot of people, like when I first started trading, I would sometimes trade without a stop loss, or I do shenanigans like that. And a news event would come along and you get wiped out, right? So you have to manage those types of things. And then the overall thing is the risk of ruin, because I mean, this is why we share that big disclaimer at the beginning of each call. Because have you ever heard of people blowing trading accounts? I've blown many trading accounts in my 12 years trading, and it's really, and the thing is, I would have never blown those accounts had I been managing risk correctly, right? I feel like everybody has to blow an account at least once in their trading career to kind of um, like learn that lesson. It's like one of those things that you kind of have to, everyone has to touch the hot stove once, you know what I mean? It's just like one of those types of things. I try to help people avoid it as much as I can, but sometimes experience is almost better than learning it. It's kind of weird that way, but yeah, sometimes it's better to touch the hot stove sooner than later. But then just learn to never touch it again and have that commitment to not do it, right? So yeah, and people can blow accounts, whether those are prop firm accounts or personal accounts. I would say it hurts a lot more if it's a personal account because if you blow up a personal account, then you'll lose a lot more money. Um, and and if you lose on a personal account, it can be highly devastating. So just because it's your own hard-earned money. If it's somebody else's prop firm account and it's a demo at that, it doesn't hurt as badly. It still hurts, but you have to get over it. My first year trading, guys, like my emotions were running high. Like I remember one time I learned this scalping strategy. I made money like 9 days in a row, but then on the 10th day, just the wrong market condition. I made a bunch of rookie mistakes and I lost everything I had made in the last 9 days of profit. And so, which we're going to actually talk about that mathematical concept here in just a moment. It's really important. I'm excited to get to that part of the call. But yeah, I've been there. And so I remember one time it affected me so much that I basically took the day off. I worked the morning and I wasn't even very effective. And I basically went home after lunchtime from work because it affected me so much. And I just basically sat and sulked in my room for the next like 6 hours or 7 hours because if it just hurts so badly, right? So again, we have to separate those things. And one of the ways you separate is just to become better, just to be better at managing risk. That way you really don't have any surprises whenever you take a trade. Okay, guys, let's move on here. So let's talk about some risk management styles that can potentially blow up an account. So one of them is martingale. And martingale, I won't read the whole thing here, but martingale is basically a style of trading. It's actually really a style of betting, not so much trading, where you double a loss. So let's say you have a losing trade, and then the next trade you take double the size. The most common place to do this is on a roulette table in Vegas. So basically, you've got your black and then you've got your white. Okay, and then there's that one green strip, which is kind of like the random factor in betting. So like 46% of the time when the roulette table spins, it's going to hit white, and the other 46% of the time it's going to hit black, and then like 8% of the time it's going to hit green. And so what people do a lot, and this is pretty, like I said, pretty common on the roulette table, is they'll go out and bet, let's say, $5 on white. And if white loses, they'll switch to black and they'll do $10 this time. And if black hits on the second try and they win that $10, they'll make their $10 back. So the $5 that they'll actually get $20 if you think about it, because you'll get your $10 back that you betted. That was your initial investment. Plus you'll get another 10 for the actual bet that was made. So you'll double your money basically. So you put in 10 and then you get 10 out. And what that does is it recovers the loss that you just had from that previous spin on the roulette table. So you get your $5 back plus another five, right? So you recover your loss and you make a little profit.
Hey traders, it's Steve from the future. I hope you have enjoyed this video so far. If you are getting value out of this video, be sure to hit the like button, click the subscribe button, and share your trading thoughts. I read all the comments, so feel free to ask any questions you have there too. On a side note, I host live trading calls like this one you are watching every day. Some of my biggest trading secrets I share exclusively to just the members in my program. I host these live trading calls every day, Monday through Friday at 11 a.m. Eastern. I also host a basic training webinar every Monday for the newer traders and the regular COT report and sentiment trading webinars every Wednesday night at 8 and 9 p.m. Eastern for the advanced and aspiring traders. All of these calls are recorded and promptly posted on the members' trading calendars at the conclusion of each call in case your schedule does not permit you to come to the live call. All of my members have complete access to the scanner. We call it Steve Scanner. This is an institutional grade trade alert scanner that picks the direction of the week on all 28 major currency pairs and includes trading instruments like gold, silver, NAS 100, US 30. Just in the last 90 days, I have made over 3,000 pips just taking the top trade signals from the scanner at the beginning of the week and then just holding those trade alerts until Friday. If you want access to the scanner, you can start a 14-day free trial with the join link in the description to get started. Lastly, if you really want to be a full-fledged VIP member of my program to get access to things like the basic training course, live signals channel, Steve's scanner, trading calendars, and the one-on-one calls with me throughout the month, you can use code YouTube50, that's YouTube50, no spaces at checkout, and save $50 on your first month. Again, just click the link in the description below and apply that coupon to become a VIP member, and I look forward to helping you with your inevitable trading success going forward. Now, back to the video.
And then what people do is they'll go back to, the $5 spin again, and then they'll double, and then they'll double, and then they'll double. And so the idea is that, they'll just switch back and forth until they get the win. Okay. And so if this is not controlled, it can be highly toxic. Okay. So I don't think all martingale strategies are a bad strategy. They're, it's not a terrible system to use. I've made a lot of money with martingale when it's controlled. Now, if you don't control martingale, you can get yourself in a lot of trouble. To me, martingale that's not controlled are martingale systems that do in fact double. So like with my overnight strategy, I guess our overnight strategy, I don't double each night. We do a 1.5% increase on the lot size every day for up to 6 days, and then we cap it at 6. And if you don't get a win within 6 days, then you're done. So we put limitations on it. Now, if you have no limitations, this is how you blow an account. So a lot of martingale systems will eventually blow up if they don't have limits, right? Um, and so I just wanted to share that if you try to go down that route, that's a lot of the times that's a big way you can lose. A very similar system to martingale is what's called a grid system. And a grid system is basically where let's say the euro is going down, but you're buying it. And every fixed amount of pips, let's say every 25 pips, you buy another one. Okay. And then the market goes down another 25 pips. And so you buy another. Meanwhile, you're still holding the losing buy trades from those higher prices, and you're still holding those. And then as the market goes down even more, another 25 pips, you buy again and again. That's a grid system. And the reason why people will do this is because they think that if the market then starts to come back up, they'll actually recover their losses pretty quickly, so long as the market does in fact go back up. Where this gets you into trouble, though, with grid systems is if the market continues lower and doesn't come back up, or let's say it doesn't come back up in time before your drawdown becomes exceptional. So like if a drawdown exceeds, 10, 20, 30, 40% of your account, that's massive. That's a huge drawdown. And it's very hard to come back from that or even feel comfortable trading a strategy like that because of how much risk you had to take in order to make that money, right? So sometimes we have to actually forego trading opportunities, even though they might make us money because of the amount of risk that it would take to make that money. So I forego a lot of opportunities every single day. Every single day I forfeit the opportunity to buy certain currency pairs or sell certain currency pairs because I have to, manage risk. Even though I could maybe buy and make some money here or sell or make some money there. Right. So anyway, back to grid systems. So these, like I said, a lot of times people use these systems to recover their bad trades. But if they're left uncontrolled or in an environment that's not conducive to a reversal like market where the grid system thrives, If that does not happen, you can blow your account. So grid systems are pretty much a no-no strategy. I'm not a big fan of them unless they have, again, limits and uh, caps to them. So an example of this would be like, let's say you want to employ a grid system. Well, if you say I'm only going to take up to 3 trades and I'm going to only risk, let's say, an average daily range stop loss for my risk on each trade, those would be appropriate caps to consider. And as long as you followed those, max out rules, you might be okay, right? So you just have to kind of formulate your game plan beforehand. But a lot of systems don't do that. In fact, I'll tell you the worst loss I ever took in trading was through a grid system. I blew an account one time. It was late Friday. This was about 7, 8 years ago. It was almost 8 years ago. It was actually about a week or two after I had just gotten married. I went out and had a very successful trading week. I had been selling the British pound and had a great week. It was Friday afternoon. I was about ready to finish my trading day. I had a really successful day, and so I was about to wrap up. And I thought, you know what? I bet I can make a little bit of extra money here. So I decided, I saw the British pound going up at the end of the day. And so I thought, you know what? Let me go ahead and put in a short position. So I put in a short and then it kept going up. So I added another short and then it kept going up again. I added another short thinking that it was going to pull back anytime now. And within about 10 minutes, I already had like 5 or 6 positions to sell the British pound. And it didn't come back. And so I kept selling. And eventually, within about 15 minutes, I had maxed out my leverage on my account. And I had already finished my day. And I just decided to get greedy and, for whatever reason, went off script and employed a grid system without me even realizing it. And anyway, long story short, within about 20 minutes, I blew that account up. Um, I lost all the profits I had made for that week, which was really hard. So very and I didn't even I've lost more money since then because I've grown and I've gotten more accounts. But at the time that was my biggest percentage loss in a single day that I'd ever had in my life. And I think today it's still the biggest percentage loss that I've ever had. I've never taken that big of a loss in a single day before. Um, but just blew the account basically. And um I only think I lost a couple $1,000, but keep in mind, 8 years ago, I was still in college, right? Like that was a couple $1,000 while going to school was a lot of money. Okay. That was a lot. And I had just gotten married too. So it felt even more devastating because I felt like incompetent and all that kind of stuff, right? Not fun, just not fun. You can only picture it. So yeah, I actually remember my wife was gone at the time when I hit that loss. And so I hopped in the shower. And I remember just kind of yelling in the shower because it felt so terrible, right? So I've been there. So it was through this type of a system where I got myself into trouble. So just don't even start this type of thing. Because even if it's enticing for a particular trade, I honestly wouldn't even start. If you do decide to use this type of thing, you've got to just put max, like, you've got to be really disciplined at managing the risk and having caps and limitations on grid systems. So, okay, let's talk about your tools. So we've got the stop loss, the trailing stop, and the lot size, or what we call position size calculator, right? Basically, what a stop loss is, it's really simple. It's just a type of order it's an add-on, it's a modification to a trade that you take, where if the trade goes against you, it will then close the trade when it reaches a certain threshold. Okay. So let's say you buy the euro dollar at 108 and you put a stop loss in at 107. If you buy the euro dollar at 108 and it goes down to 107, the stop loss will, on your behalf, take you out of the trade to protect your account. You must use a stop loss. Okay. So I've traded for 12 years. I've tried many different ways to trade without a stop loss. The only type of style of trading that I've been able to successfully do, like I said, successfully, without a stop loss is as an investor approach. So let's say, for example, like in the stock market, I like something like do a Warren Buffett type of thing. So let's say you're Warren Buffett, and so if I'm putting my Warren Buffett cap on, the time I won't use a stop loss is if, like, let's say I like Coca-Cola and I believe in Coca-Cola, it'll be here in 20 years, it'll be here in 30 years. So if it's good to buy now at whatever price it is, it'll be good to buy in 30 years, right? If that's my mentality towards Coca-Cola, then I'm not going to use a stop loss because I'm an investor in Coca-Cola, right? So I've done lots of things like that where I haven't used a stop loss, but it's stuff that I believe in that, if the market goes down, my mentality is, well, I don't care that it's down. I'm just going to buy more because I believe in Coca-Cola, right? That's your Warren Buffett cap. But the thing is, I don't necessarily believe in the euro. I don't necessarily believe in the US dollar. I don't believe in the Aussie as a long-term investment. And so I'm not in it as an investor. I'm in it for income. I'm in it for as a trader, right? And so because of that, I have to be I have to limit, I have to put limits on the euro. I have to put limits on the Aussie and the US dollar and the Canadian dollar and so on. And you do that by having a stop loss. Okay. So, like I said, just different mentalities of investing versus trading. And there's other things like I've bought, like I know this is kind of a more risky investment, but you guys know I've been buying cryptocurrency. So I've been buying Bitcoin. I buy Bitcoin every day, a fixed amount of money, and I don't care if it goes down, I don't stop out. There's no stop loss because I believe in it and I have a time frame in my mind of when I'm going to close it, and I'm going to hold it into next year, probably take my profits end of next year is kind of my game plan. And so every day I buy more, and if it's down a lot, I buy even more, right? So it's a different type of style. And I'm not in it for income this week or next month. I'm in it for the larger capital gain that will approach over, a year and a half or a year from now. Okay. So different type of style. Right. Okay. So I hope that makes sense. You've also got things like trailing stops. Basically, a trailing stop, what that does is it follows the market. So, like if a trade goes in your favor and you have a stop loss at, say you buy the euro at 108 and your stop loss is at 107. Let's say the euro dollar goes to 109. So it goes in your favor, a full penny. Um, um, so the so what I so if the trade goes in your favor a full penny, so what happens is the trailing stop will go in your favor as well, a full penny as well, and so it actually moves. The trailing stop will cut the risk as the trade goes in your favor. That's what a trailing stop does. It has its pros and cons. We don't have time to go into all of it, but basically, the biggest con to a trailing stop is if a trade goes in your favor, but then and the trailing stop subsequently moves up, but then the market dips for a time, it could potentially stop you out of a good trade just as it starts to go back in your favor again. Okay, so anyway, there's that. And then you got the position size calculator. We're going to talk more about that later, so I won't spend too much time on this slide. Okay, so let's talk about the risk management scenarios. Okay, this is the part that I think is really eye-opening to a lot of folks. It was very eye-opening to me to put this together. So let's go over the math. What's required to be profitable as a trader? So let's talk about scenario one, which is a 1-to-1 RR ratio. So when we talk about RR ratios, what is an RR ratio? RR is your risk to reward. There's basically two variables that determine your profitability in trading. Number one is your win-loss ratio. This is the one that most people are most familiar with. Okay, so a win-loss ratio is like saying, how often do you win? Do you win 60% of the time that you take a trade? Do you win 70% of the time that you take a trade? Do you win 80% of the time? How often, how often do you win is um, basically what a win-loss ratio is. Okay. Okay. So basically that's the number one variable. The second variable that determines your profitability is your average win to average loss ratio. Okay. So this is the one that people don't talk about as much, but in my opinion, it's like the most important thing to talk about because I think so many people are fooled by or enticed by the win-loss ratio. They think that if they just win Most of the time, that's all that it takes to be profitable. But what I've discovered is that it's how much you make when you win or how much you lose when you lose really determines your profitability. Because we have this, like, for example, this overnight trading strategy. It has a 28% win rate. It hovers between like 27 to 29% win rate. Um, that's just been the average. Okay, so it doesn't win all that often. Like a quarter percent of the time is how often it actually wins. Most people from just that standpoint would be like, okay, I'm not going to trade that because it only wins a quarter percent of the time. The thing is, though, if you understand your RR ratio, meaning your average win to average loss, if your average win is 7 times what you're losing on your average trade, all of a sudden winning 28% of the time makes a lot of sense. Okay. It's okay if you only win 28% of the time if the average winner is 7 times what your average loss is, right? And we're going to get into some other scenarios here in just a little bit, but like, for example, somebody who wins 90% of the time, but their average win is, let's say you risk, here's an easier scenario. Let's say you win 90% of the time, but your stop loss is 100 pips, but your average win is only 2 pips. Um, that 10% of the time that you hit your 100 pip stop loss makes the strategy grossly unprofitable, right? So it doesn't matter that you win 90% of your trades because your RR ratio is so out of line. Okay, so you kind of have to achieve a balance between RR ratio and your win loss ratio. So I'm going to go through that scenario basically right here. So with the 1-to-1, this is a really simple one to understand. Basically, if you take 100 trades, you need to win 50% of your trades to break even. Um, Now, you do have spread and commission tied to that as well. So you might need to win maybe 51% of your trades or 52% of your trades to break even at a 1-to-1. This is basically saying if you were to take a trade and you had a 25 pip take profit and a 25 pip stop loss, that's a 1-to-1. You're risking 25 pips, you're going to make 25 if you win, lose 25 if you lose. That's 1-to-1. So 50% is what's required to break even. Okay. So if you want to be profitable at 1-to-1, you have to be winning more than 50% of your trades. Okay. So that's really important to and that's just to barely make profit. If you want to be very profitable, you need to start winning 70 to 80% of your trades at a 1-to-1, which is a little harder to do. So I don't actually do 1-to-1s anymore. I used to a long time ago, but I don't use 1-to-1s because you do need a very high win rate to be profitable. Okay. Then you have the 1-to-2. This is risk to reward. So 1-to-2 risk to reward scenario. So an example of 1-to-2 would be a 10 pip stop loss and a 20 pip target. Okay. So basically, when you take this trade, you're risking 10 pips with the potential to earn up to 20. If you take this trade 100 times, take 100 trades at a 50% win rate, you will make 1,000 gross pips and lose 500 gross pips as well. So your net will be 500. You only need to win 33% of the time to break even. So this is very interesting. 33% of the time is just to break even. Because if you think about it, 90% of traders lose money. So if they were to just win 33% of their trades at a 1-to-2, they would actually be breaking even. Easier said than done, right? So you need a strategy that it gives you 1-to-2s most consistently. The trade we took this morning was a 1-to-2, right? I don't know if you guys recall, but we did that this morning with the pound yen GJ. We did a 1-to-2 RR ratio. So if we were to take that trade, you know, 4 times, we would need to just win a little over once, like 1.5 times to be profitable, just to hit the 33%. Even at just 25% of the time, you're actually getting pretty close. You're not losing much at a 33% win rate or at a less than 33% win rate. So if you think about it, if you could get yourself to a 50% win rate at a 1-to-2, now you're cooking, right? You're really cooking at that rate. See where I'm going with this? And so that's what I'm saying. The RR ratio perhaps might be the most neglected variable when people are when retail traders, people like you and me, are setting out to trade, they don't consider the RR ratio. Everyone's so infatuated with their win rate that they forget the RR ratio and how important it is, right? So yeah, just 33% of the time puts you at break even, which already sets you apart above 90% of other traders just at that rate. So let's move on to the next one. So this is my favorite scenario. This is the one I try to achieve every time I take a trade. When I'm hunting for trades in the morning with you guys, these are the types of trade opportunities that I'm after. I'm after at least a 1 to 3. I will take a 1 to 2 on a buy stop or sell stop order like we did this morning. But if we're going to use a limit order, I'm definitely going to be after a 1 to 3. If possible, we'll try to go 1 to 4, maybe even 1 to 5. Okay, so what does this one look like? An example would be a 10 pip stop loss with a 30 pip take profit. With this, if you took 100 trades, you would only need to win 50 at a 50% win rate, you would make 1500 gross pips and you would lose 500 gross pips for a net profit of 1,000 pips after 100 trades. This requires a 25% win rate to break even. That's incredible. If you think about it, you only need to win 25% of the time just to preserve your capital, which was the whole mission of this webinar, right? The preservation of capital. Preservation of capital at a 1 to 3 RR is happening at a 25% win rate. Pretty incredible, right? So if you told people, let's say you went to the cafe on Saturday morning to go meet with your buddies to go have a breakfast, and they said, "How did you trade this week?" And you said, "I only won 25% of my trades." Well, they might be like, "Oh, dang, I'm sorry to hear that." But if you said, "Well, no, it was at a 1 to 3 or it was at a 1 to 4 RR ratio. So I actually made a little bit of money this week or I broke even." Well, that's fantastic, right? Your other buddy might say, oh, you might ask him, well, how did you trade this week? He might be like, well, I won 90% of my trades, and everyone will be like, oh, that's awesome. You won 90% of your trades, and and then he might say, well, yeah, but I still lost money, right? Because, maybe his RR ratio was out of line, which, by the way, I will just say most often than not, if somebody is proclaiming a 90% win rate, their RR ratio is probably super upside down, which is really not what you want to see. The cool thing about these types of RR ratios, just hear me out on this part because it's really important to get this. Every strategy has its losing periods. Doesn't matter what you do. Could be the overnight strategy, it could be price action trades, could be the weekly trades, it could be anything. Could be even a strategy that I don't even teach, just something that you came up with or that you learned from somebody else. Every strategy has its losing periods because the markets change. The dynamics of the week to week are different. The news events, everything changes. And so you are going to hit losing streaks no matter what you do. And so because of that, if your strategy requires an 80% or a 90% win rate to break even, and you hit a losing streak, it becomes very difficult in the future to recover those losses. Now, if you have a losing streak, when you have a losing streak, rather, because everyone will, no matter what strategy you trade, and that losing streak goes on for a week or so, let's say, and you're doing this that you see on this slide, you're managing the risk, you're adopting that 1 to 3 RR ratio or pretty darn close to it each time. Um, the next week comes along and it won't take you too long to recover your losses from the previous week because you've adopted such a good, sound risk management style and model here. All right. Um, you can afford a losing streak because when you win and when the market condition is just right for the style that you trade, it's very, very lucrative on the other side of that. Okay. So I just wanted to point that out that that's really, really important. And it becomes much easier to recover any losses that you've had from a losing streak when you adopt this style. The challenge is to have the discipline to stay with it because it's really easy to forget this style if you haven't had a winner in a while. Because I feel like sometimes we have this need to just want to win more often. We, when even if we're not making money, but we're winning, we kind of like trick ourselves into thinking that we're actually being profitable when we're actually not profitable, but maybe we're having some wins right now. Okay, so just another thing to think about as you go forward here. Okay, any questions on this style? This is the golden ratio style. So take a picture of this or take a mental note of this because this is the style that I I usually am after, the 1 to 3. Um, I'll always talk about that in the webinars. Very important to try to get 1 to 3 on your price action trades. That's just kind of the Goldilocks zone to be at. So above this is better if you can get it. If you, even below this is okay, but I don't like to go much below the 1 to 3. This is the standard 1 to 3. Okay. Okay. So let's talk about scenario 4. This is the other way. So this is 3 to 1. So instead of 1 to 3, it's just the opposite. So instead, you're risking 30 pips to make 10. Check the math out on here, guys. Math ain't math in here. Well, actually, math is math in here, but it's interesting math. Check this out. If you take 100 trades at the 30 pip stop loss and 10 pip target, okay, easy, it's going to be easier to hit that, right? You're going to hit your win more often than your loss just naturally. Just by natural course, you're going to hit your 10 pip target more easily than that. So your win rate will be higher, but just check this out. If you only won 50% of those, okay, think about this. Um, you'll only make 500 pips in gross profit and you'll lose 1500 in gross pip loss. So your net's going to be minus 1000. In order to break even, you need to win 75% of your trades. So that means you take 4 trades, 3 of those will have to hit. If just and that's not even making money, guys. That's just breaking. And then you have commission costs and spreads and things like that that could also hit you. So really you might be looking at a 77 to 78% win rate just to be breaking even. Okay. I mean, that's think about it. That's take 5 trades. 4 of them have to hit profitable, full target to be able to make money and you can only afford 1 loss. And that's just breaking even, spinning your wheels. Okay. So this is why 90% of traders lose. This is honestly it right here. It's not even the strategy that people are trading. It's their inability to adopt sound risk management. Okay. Um, because all the if you don't have a strategy that's working for you, that's easy. You can be taught that by anybody, me or anybody else has good strategies. The question is, can you have the discipline to hang on to this style that works? Not the one that you're looking at, but the one from, this previous slide right here. Can you adopt this and stick with this style right here versus this right here? So don't trade this way, right? Like I said, it's going to require a 75% win rate just to break even. Which, like I said earlier, every strategy has its down periods. And so if you drop from, let's say you're winning 80% of the time, so you're barely profitable. If you drop to 60% win rate, which is still good for most strategies, you're losing so much money, even winning 65% of your trades. You're still losing tons. And even if you were winning 80% or 85% of the time, it doesn't matter that you are winning that for a period because the amount of losses in the water that you're taking on during that losing period is so great, right? You see what I'm saying? See why we're doing that? So while I've got you here, let me show you on the overnight strategy, like the statistics, guys. Let's go over these numbers. So, um, um, you guys already know, most of you know how this strategy works. It has a very low win rate, but the average win to average loss is so much greater. So yeah, it's a 27.77% win rate. That's the current win rate of the overnight trading strategy. Um, Now, since May 1st, it's brought in over, this is on a 100K account. The gross profit has been $63,000. Now, there are losses, obviously, because I'm only winning 28% of the time. And so naturally, 72% of the time, I'm losing money. And during that 72% of the time, we lost $28,000. So if you take the minus gross profit minus gross loss, the net is over $34,000. And we've taken, since May 1st, I've taken 90 trades. Okay, 90 trades since May 1st. Today is August 12th. I've had 64 losing trades and 25 winning trades. Okay. The average losing trade has been minus $438 on a $100,000 account. Of the 25 winning trades, the average win has been $2,514.86. Okay. So if you actually run these numbers here, let me grab a calculator here. If you take 2514.86, which is the average winning trade, and you divide that by the average losing trade, which is $438, 438 and 48 cents, that means that the average winning trade is 5.74 times larger than the average loss. That's fantastic. Um, so yeah, that means our RR ratio is close to 1 to 6. So we're basically 1 to 6 RR. I don't know what the break even would be on that. I need to figure out the numbers. I got to math that out and figure that out. But um, yeah, at a 20, I'll tell you right now, at a 27 or 28% win rate, that's extremely profitable. And we could actually dip below that just to break even. Yeah, you could actually have a win rate that's much less than 28% and be breaking even. And that's crazy to me. So you can afford losing periods consecutively over time and still come out profitable. This is the little secret, like I said, that not a lot of people will tell you, or maybe they, here's the funny thing. I think everyone knows this. Maybe they understand this, but maybe they don't believe in that, or they don't believe in themselves to be able to create profits like this. Whatever the reason is, people just don't do this. Like I said, 90% of retail traders lose money, and I think the biggest challenge is them believing, having the ability to believe that they could pull profits like this with an average win like this and an average loss like this. A lot of people aren't willing to subject themselves to a win rate this low. I don't know what it is, but as humans, we feel like we got to get that win all the time. Like, if we're not winning, we're not making money. At least it feels that way. But like this morning, we went through a scenario. We said if we won tonight, because we're actually kind of deep in the sequence here, but if we won tonight, the win would be so much greater. In fact, that would be my win right there, over $6,000 tonight if I won on the euro dollar, if I got a win. And it would be so much greater than these losses from the previous days in the sequence. It just absolutely obliterate those losses. Um, but I've had to wait since the last winning trade I had was on the 6th. So that was on Tuesday. So today is Monday, the 12th. And the last winner I had was on the 6th. And hopefully we get a win tonight. If not, then we'll have to wait and see if we can get it on Wednesday, and go from there. But even then, if we don't win, it's not the end of the world. You just restart the sequence. It'll set you back about 2 or 3 weeks in losses. It hasn't happened to me yet, by the way. I think I've said that before, but yeah, it would set you back a little bit if that happened. But yeah, I'm looking forward to seeing if we can get a good win tonight. It'd be great. Um, or tomorrow. So, but yeah, just like I said, back to this. Really important to keep your. So this is the scenario. I want you guys to adopt this type of style. Whether you use the golden ratio at 1 to 3, or if you use a 1 to 4 or 1 to 5, or like the overnight trading strategy, which is nearly 1 to 6. Um, try to aim for that type of a style of trading. Another reason why I think that's hard for people to do is because in order to get a win rate, or excuse me, an average win to average loss that's so much greater, in order to get that, it usually requires a trader to be more patient with their trades. Okay. So, um, just like hear me out on this. So, traders who have a high win rate, I can almost guarantee they're scalpers. Okay. And traders who have a high average win to average loss ratio, but maybe a lower win rate, are probably swing traders. And the reason for that, or they, they're not day traders necessarily in the normal day trading sense. And the reason why is because they're hanging on to their winning trades longer than their losing trades, right? So most of the people I know that are profitable in the markets don't do a lot of very short-term trading. They do this more longer-term style. So, all right, guys, any questions? We're gonna go ahead and wrap up here. I think that's a pretty good webinar. I think we covered everything I wanted to discuss. I think it was pretty good. All right, guys, appreciate each one of you. Thank you for coming. Have a fantastic rest of your Monday, and we'll see you guys in the next webinar.